Most people believe markets react to obvious events. Bad news hits the headlines, prices move, and everyone assumes cause and effect is straightforward. But markets rarely work that way. Markets don't fear bad news. They fear what most participants haven't fully recognized yet. When prices rise steadily without panic, without headlines screaming crisis, and without retail enthusiasm, that is often when something structural is unfolding beneath the surface. Not a moment of fear, but a moment of quiet repositioning. Right now, many investors still frame gold as a crisis asset, something that performs only when stocks collapse or when the world feels unstable. That framing is incomplete. Because the most significant market moves do not usually begin with fear, they begin with reallocation. They begin when large institutions, pension funds, central banks, sovereign entities start adjusting portfolios for reasons that are not emotional, not reactive, and not visible on daily news cycles. By the time a narrative becomes obvious, the repricing has often already occurred. So the relevant question is not whether gold has gone up or whether it feels expensive today. The relevant question is whether something has changed in how capital is being positioned, and whether most investors are still looking at yesterday's explanations to understand today's price behavior. That's what we're going to examine, calmly, methodically, and without speculation. Over the past 12 months, the gold market experienced a period of unusually strong and persistent price appreciation. During 2025, gold recorded its strongest annual performance since 1979, rising by over 60% for the year, according to Reuters. Throughout that period, gold set more than 50 new all-time highs, reflecting a steady upward repricing rather than a single event-driven spike. The average gold price in 2025 was approximately $3,400 per ounce, with prices accelerating into the fourth quarter. By late 2025 and into January 2026, gold reached new record levels before experiencing a moderate pullback, consistent with profit-taking following a strong multi-month advance. Notably, this price movement occurred during a period when U.S. equity markets also posted positive returns. Historically, sustained rallies in both equities and gold at the same time have been relatively uncommon, as gold has often been viewed as a defensive or countercyclical asset. From a demand perspective, central banks remained a major source of buying. Data from the World Gold Council confirms that global central bank gold purchases exceeded 1,000 tons per year for multiple consecutive years, including 2024, marking one of the most sustained periods of official sector accumulation on record. In parallel, gold investment flows increased, particularly through exchange-traded products, though overall portfolio allocations to gold across global investment funds remained relatively low compared to historical peaks. On the macroeconomic side, the period was characterized by elevated government debt levels in major economies, ongoing debates around inflation persistence and monetary policy normalization, gradual shifts in reserve management behavior following geopolitical events earlier in the decade. Compared to the prior year, what changed most notably was the speed and consistency of gold's advance, rather than short-term volatility. The move was not driven by a single shock or crisis event, but unfolded across months alongside ongoing central bank participation and relatively stable financial conditions. These are the observable facts as they stand, without interpretation. The recent movement in gold prices matters less because of the magnitude of the move, and more because of what it reveals about capital behavior. At a first-order level, the most visible effect is price appreciation. Gold moved higher steadily, without the sharp volatility spikes typically associated with panic-driven buying. That matters because it suggests allocation-driven demand, not crisis hedging. The second-order effects are more important. When large institutional actors, particularly central banks and long-duration investors, increase exposure to gold, they are responding to structural constraints, not short-term narratives. Central banks, for example, operate with multi-decade time horizons. Their actions are influenced by reserve security, liquidity, and long-term purchasing power, not quarterly performance targets. This creates a chain reaction. Central banks accumulate physical gold. Available supply in the open market tightens. Marginal buyers must pay higher prices to acquire the same quantity. Price becomes less sensitive to short-term sentiment. At the same time, institutional portfolio managers face a different constraint. Many diversified portfolios remain heavily concentrated in financial assets whose valuation depends on stable interest rates, stable currencies, and predictable correlations. As debt levels rise and monetary policy paths become more uncertain, portfolio resilience becomes a priority, not return maximization. Gold functions differently from most financial assets. It carries no credit risk, no counterparty risk, and no dependency on cash flows. As a result, when institutions increase gold exposure, they are not expressing a directional view on inflation or growth. They are reducing dependency on a single monetary framework. Who is impacted first? Central banks adjust reserves quietly. Large asset managers rebalance strategically. Long-term funds adapt allocation models. Retail investors typically appear much later in the cycle, once price movement becomes widely discussed. Another key implication lies in correlation behavior. Gold rising alongside equities indicates that gold is not being treated solely as a defensive asset. Instead, it is increasingly functioning as a structural portfolio component, similar to how it was treated in certain periods of the 1970s and early 2000s. This shift matters because once an asset transitions from tactical hedge to strategic allocation, demand becomes persistent rather than opportunistic. That changes how prices behave during pullbacks, how volatility resolves, and how the market absorbs supply. In other words, the significance of this move is not about today's price level. It's about how capital is being repositioned across the system and what that implies for future sensitivity to macroeconomic changes. Periods of strong gold performance are often remembered through their outcomes. That memory bias can distort analysis. To understand the present environment, it is more useful to examine what conditions look like before prior repricing phases, rather than what happened after prices peaked. One relevant comparison is the late 1970s, a period characterized by persistent inflation, rising fiscal deficits, and declining confidence in monetary discipline. In the years leading up to gold's peak in 1980, price increases were not driven by sudden panic. Instead, they unfolded as institutional actors gradually recognized that real interest rates were negative and that monetary expansion was structurally embedded in policy decisions. Another useful reference point is the early 2000s through 2011. In that period, gold rose steadily amid expanding sovereign debt, accommodative monetary policy, and repeated financial system stress. Importantly, gold's advance began before the global financial crisis became obvious. The early phase was marked by portfolio diversification and reserve adjustments, not fear-driven retail demand. There are similarities between those periods and the current environment. Elevated public debt relative to economic output, long-term questions around monetary credibility, institutional reallocation occurring before widespread public participation. However, there are also critical differences. Unlike the 1970s, today's financial system is more globally integrated and more reliant on market-based financing. Unlike the early 2000s, today's central banks are operating in an environment where reserve assets can be subject to geopolitical constraints, altering how reserve security is assessed. Another difference lies in market structure. Modern financial markets allow capital to move faster, but institutional mandates still change slowly. That creates a dynamic where price moves can begin quietly and persist longer than expected, without the emotional extremes seen in earlier cycles. Most importantly, history shows that gold does not require identical conditions to perform. It responds to imbalances, not narratives. In each prior cycle, the exact catalyst differed, but the underlying theme was the same: a reassessment of long-term monetary assumptions. The purpose of historical context is not to suggest that outcomes will repeat. It is to demonstrate that when gold reprices over extended periods, it usually reflects gradual shifts in capital behavior, not sudden collective fear. Understanding that distinction helps separate analysis from emotion. Professional market analysis does not rely on a single forecast. It evaluates multiple conditional paths, each dependent on how key variables evolve. Below are three structured scenarios based on currently observable conditions, using conditional logic rather than certainty. Bull case: structural strength continues. If current trends in official sector demand persist, and if real interest rates remain constrained by high debt servicing costs, then gold could continue to trade at elevated levels or move higher over time. In this scenario, central banks continue to add gold to reserves as part of long-term diversification strategies. Monetary policy remains cautious, limiting sustained upward pressure on real yields. Portfolio managers incrementally increase strategic allocations to gold as a stabilizing asset. Several financial institutions have modeled outcomes under similar conditions. For example, Goldman Sachs has published a forecast, not a guarantee, of gold reaching approximately $5,400 per ounce by the end of 2026, citing sustained central bank demand and macro uncertainty. JP Morgan, in a separate forecast, has outlined a base expectation around $6,300 per ounce by late 2026, contingent on continued institutional flows. In this scenario, price strength is driven less by speculative momentum and more by persistent allocation demand, resulting in relatively shallow pullbacks and reduced sensitivity to short-term sentiment. Base case, stabilization after repricing. If inflation moderates gradually, and if monetary policy avoids both aggressive tightening and renewed large-scale easing, then gold prices may consolidate within a broad range following their recent repricing. In this case, central bank purchases continue but at a slower pace. Investment inflows stabilize rather than accelerate. Gold remains a portfolio diversifier rather than a momentum asset. Here, gold functions primarily as a store of value and volatility dampener, maintaining relevance without sustained directional pressure. Price movements would likely be influenced by shifts in real yields, currency trends, and incremental changes in allocation models. This scenario aligns with the assumption that recent price gains have already incorporated much of the available macro information, and future movements depend on confirmation rather than surprise. Bear case, decisive shift in macro conditions. If real interest rates rise meaningfully and persistently, and if fiscal pressures ease enough to reduce concerns around long-term monetary credibility, then gold could face sustained downside pressure. This would require strong economic growth without renewed inflation, a durable rise in real yields, reduced institutional urgency to hold non-yielding reserve assets. Under these conditions, gold would likely lose relative appeal compared to income-generating assets. Portfolio allocations could shift back toward yield-sensitive instruments, leading to outflows from gold-related holdings. It's important to note that this scenario depends on multiple variables aligning simultaneously, which historically has been less common in high-debt environments. However, it remains a valid conditional path and must be considered in any disciplined risk framework. Why scenarios matter? Markets rarely follow linear narratives. Scenario analysis helps avoid overconfidence by recognizing that outcomes depend on what changes next, not on what has already occurred. This framework is not about predicting prices. It is about understanding what conditions would need to change for the trend to strengthen, stabilize, or reverse. Rather than focusing on headlines or short-term price movements, professional analysis relies on a small set of indicators that tend to lead behavior, not react to it. These are the signals I monitor to assess whether conditions are changing beneath the surface. One target, US dollar index, DXY gold, has historically shown an inverse relationship with the US dollar over long periods. What matters most is not daily fluctuations, but trend persistence. Sustained dollar strength can pressure gold, while prolonged dollar weakness often reflects broader macro adjustments that support gold as a reserve asset. 2. Real Treasury yields. Nominal yields alone are insufficient. The key variable is real yields. Nominal yields adjusted for inflation expectations. When real yields are rising consistently, gold tends to face headwinds. When real yields are constrained or declining, gold's opportunity cost decreases, supporting institutional allocation. 3. Inflation measures, akin to CPI and PCE. These indicators matter less for their absolute readings and more for directional surprises. Markets respond to deviations from expectations. Stable or moderating inflation, combined with restrictive policy, can alter gold's relative appeal. Persistent inflation can reinforce its role as a store of value. 4. Central bank balance sheet trends. I watch changes in the pace of balance sheet expansion or contraction. While gold is not mechanically tied to balance sheets, long-term liquidity conditions influence how institutions manage reserve risk. 5. Gold ETF flows and positioning data. Investment flows help identify who is participating. Rising prices with modest inflows suggest institutional demand is still dominant. Sharp inflow spikes can indicate late-cycle retail participation, which often coincides with higher volatility. 6. Market liquidity and volatility. Tightening liquidity conditions can pressure all assets temporarily, including gold. The key is whether gold stabilizes faster than risk assets during liquidity stress, a sign of structural demand. Together, these indicators provide a framework for assessing whether gold's role in portfolios is expanding, stabilizing, or contracting, independent of daily price noise. Markets are rarely about certainty. They are about probabilities, positioning, and patience. What we've discussed is not a prediction of where gold must go next, nor a call to action. It's simply a framework for understanding why gold has behaved the way it has, and what conditions would need to change for that behavior to shift. Gold's recent performance reflects structural forces, debt dynamics, reserve management, and portfolio construction, rather than emotion or crisis response. Those forces evolve slowly, and they deserve to be observed with discipline rather than urgency. For any investor, the most important questions remain the same. How much risk are you taking? How concentrated is your exposure? How dependent is your portfolio on a single outcome? Risk management is not about avoiding volatility. It's about staying positioned so that volatility doesn't force decisions at the wrong time. This isn't investment advice. It's simply how I'm reading the market right now, calmly, with humility, and with respect for uncertainty.